Trading near $3.54, Fubotv, ticker symbol FUBO, has recently been moving with a noticeable volatility, residing far from its 52-week high of $6.45, but standing significantly above its 52-week low of $1.21. At first glance, the narrative around Fubo is a familiar one for a streaming company, a battle for scale, profitability, and relevance in an aggressively competitive landscape dominated by tech behemoths. The common expectation is that Fubo, a sports-first live TV streaming platform, is a niche player perpetually on the brink, struggling to justify its existence against the likes of YouTube TV, Hulu Plus Live TV, and the coming ESPN Unlimited joint venture from Disney, Fox, and Warner Bros. Discovery. The narrative suggests its path to success is fraught with impossible obstacles. But this surface-level analysis misses a fundamental transformative shift in Fubo's DNA, a strategic pivot that has seen the company move from a reckless pursuit of growth at all costs to a disciplined, almost contrarian focus on profitability and a lean, optimized business model. This is the unexpected reality. Fubo is not just surviving, it is actively reinventing the rules of engagement, and this subtle but profound change is what truly redefines its investment thesis. The first critical insight that challenges the prevailing narrative is Fubo's recent and deliberate shift away from a subscriber-at-all-costs model. For years, the market conditioned investors to view streaming companies through a single lens: subscriber growth. The higher the number, the better the stock, regardless of the staggering losses incurred to acquire each user. Fubo played this game, and the results were predictable: a ballooning net loss and a stock price that mirrored the volatile sentiment of a cash-burning startup. However, in its most recent quarter, Fubo delivered a stunning plot twist. The company not only exceeded its revenue guidance, but it also achieved something far more significant: its first quarter of positive adjusted EBITDA, reaching over $20 million. This milestone, a staggering $31.7 million improvement year over year, was achieved despite a decline in its North American subscriber base. Now, this is where the tension between expectation and reality becomes palpable. The market sees a subscriber loss and instinctively recoils, assuming failure. But the deeper truth is that this was a conscious strategic decision. Fubo pruned its less profitable high-trend subscribers and focused on optimizing its customer base for higher average revenue per user, ARPU. The data bears this out. Its North American ARPU has continued to climb, driven by a higher value, more engaged user base that is willing to pay for premium sports content. This is a complete reversal of the industry standard. While rivals are spending billions to acquire every possible user, Fubo is demonstrating that a smaller, more profitable, and higher value user base can be a more sustainable and compelling business model. This strategic discipline signals a maturation of the company's leadership and a fundamental reevaluation of its long-term viability, moving from a speculation play to a genuine business with a path to free cash flow. Expanding on this new financial discipline, it's crucial to understand how Fubo is executing this profitability-first mandate on a micro level. The company is actively renegotiating content deals and, crucially, shedding networks that do not meet its profitability metrics. The loss of certain content from major providers like Warner Bros. Discovery and Televisa Univision, which led to a minor year-over-year dip in ad revenue, is not a setback, but a calculated trade-off. Fubo is choosing to walk away from deals where the licensing costs are disproportionately high relative to the value they add to the subscriber base. This is a difficult but necessary move that few of its competitors are willing to make, as it risks a hit to the headline subscriber count. But for Fubo, it's about shifting the focus from top-line revenue to bottom-line efficiency. This is where the company's proprietary data and technology platform come into play. Fubo's strength is not just in its content, but in its ability to understand what its core sports audience values most. By focusing on essential high-demand sports content and eliminating the filler that inflates costs, Fubo can offer a more compelling, lean, and ultimately more profitable service. This is the core of its skinny bundle strategy, epitomized by its upcoming Fubo Sports service. This new offering, which will aggregate essential sports networks at a lower price point, is a direct response to a consumer landscape increasingly burdened by streamflation. By catering to the price-sensitive, sports-obsessed cord cutter, Fubo is carving out a defensible and highly targeted market segment. This application of its strategy, analyzing data, making tough content decisions, and launching new products is what makes its pivot to profitability so compelling and differentiated from the competition. Another layer of Fubo's evolving story is its international and multi-platform strategy. While the North American market remains its core, the company's acquisition of Molotov in France is an underreported but potentially transformative move. Molotov is not just another streaming service. It's a technology platform with a significant user base and a deep understanding of the European market. By integrating its technology with Molotov's platform, Fubo was gaining a foothold in a new geographic region and, more importantly, is diversifying its revenue streams. It has already announced significant sports rights discussions in France, which could lead to new exclusive content offerings that are not beholden to the same bloated licensing costs seen in the US. This isn't just about global expansion. It's about creating a two-pronged strategy where the US business refines its profitability model while the international segment acts as a proving ground for new content and technology partnerships. The company's recent partnership with DAZN in Canada further illustrates this international ambition, expanding its content offerings without the massive upfront capital expenditures of a full-scale acquisition. This is a far more intelligent and less risky way to expand than simply burning cash on marketing to acquire users in new untested markets. The central tension of Fubo's future and its stock is the pending merger with Hulu plus Live TV, with Disney acquiring a majority stake. The general expectation is that this is a raft light for Fubo, a lifeline that saves the company from the impossible struggle of competing against giants. While there's an element of truth to that, it's a gross simplification that misses the nuanced strategic implications. The reality is that this merger isn't just about Fubo's survival, it's about Disney's recognition of Fubo's unique value proposition. Fubo is the only live TV streaming platform with every English-language Nielsen-rated sports channel. Its user base, while smaller, is incredibly valuable and engaged. By integrating Fubo's live sports expertise and technology into the broader Disney-Hulu ecosystem, Disney is not just acquiring a user base, it's acquiring a blueprint for a more profitable and sports-centric streaming service. The deal is backed by a substantial cash infusion and a commitment to new carriage agreements, which will give Fubo access to Disney's vast content library and, more importantly, its powerful distribution channels. This is a two-way street. Fubo's expertise in live sports, interactive features like multi-view, and free-to-play games, and its lean and mean profitability model could be the secret sauce that makes the combined entity a true force in the streaming world. The strategic review of its sports betting unit further reinforces this. Instead of building out a costly in-house sportsbook, Fubo is exploring partnerships with established operators, de-risking a major initiative while still capitalizing on a multi-billion-dollar market. This is not the move of a desperate company. It is the calculated decision of a management team that has learned its lessons and is now playing a much smarter, more disciplined game. The market, fixated on the competition, is missing the fact that Fubo may be on the verge of becoming an indispensable, specialized asset within one of the world's largest media conglomerates. In conclusion, the story of Fubotv is one of expectations versus reality. The expectation, for a long time, was that it was a cash-burning, niche player destined to fail in the face of overwhelming competition. The reality, as demonstrated by its Q2 2025 results, is that the company has undergone a fundamental transformation, pivoting to a disciplined and profitable business model. This strategic shift is not just about survival. It is about building a more sustainable and valuable company. By shedding unprofitable content, optimizing for higher ARPU, and pursuing a lean, product-first approach, Fubo is rewriting the rules of the streaming wars. The company's international expansion and, most critically, its pending strategic alliance with Disney's Hulu plus Live TV are not acts of desperation, but calculated moves that acknowledge and leverage Fubo's unique value as a sports-first platform. While others continue to chase subscriber numbers at unsustainable costs, Fubo is proving that a targeted, profitable business can be far more compelling in the long run. The central insight remains: what the market perceives as a weakness, subscriber loss, is in fact a reflection of a newfound strength and discipline. The narrative has changed, and Fubo is now building a business, not just a subscriber list, making it a story far more complex and intriguing than its headline-grabbing competitors.